We were on learning number 7. We're dealing with example what on learning number 7? Unrealized profit on the sale of what? The parent was selling what do we call the inventory. So we were here whereby the B limited was happening an opening inventory of 20,000. You still remember that 20,000 opening inventory as per the information from the adjustment. We're still seeing profit and loss. Then so on our statement of profit and loss, we were calculating the revenue part, which we had
No, sir. On my side, we stopped on profit before tax.
yes, that's where we stopped. And I requested that you can complete it if you willing. We were here, right? You remember this part?
Yes, sir.
Okay. Then can we proceed? So we're gonna have income tax expense. Okay, we said the when we add all this together, they give us how much? 138, ne? This one. Then we have an income tax expense.
Sorry, sir.
Mm-hmm.
Hello.
Yes, I'm listening.
Yes, I would like to know which question are we doing.
Example 3. Example 3, learning unit number 7. Parent selling subsidiary of selling inventory. So we have income tax expense of 50,000. Then when we do the sum up, we arrive at 88,000. And then from there we have it will be our profit for the year. We are all happy, right? I would prefer if you respond, because if you don't respond, maybe my network is having issues, but you don't hear me. I'm thinking you are hearing me.
Yes, sir.
Then other comprehensive income. Which will be nil. We don't have one. And then the total comprehensive income for the year. It will be 88. Then we have total comprehensive income attributable. Owners of the parent. So which it will be the 88,000 you have minus this one. On the profit, remember you had that 8,000. This one, you have to deduct it as a non-controlling interest. Then you have 80. And then the non-controlling interest. You hold on. Okay, sorry for that. We have a non-controlling of 8,000. So when you add all this together, they give us 88,000. It's like just a show up how this amount was breaking up. We all happy, ne?
Yes, sir.
Okay, then we're gonna have statement of changes in equity. So the thing involved here, it will be total equity we have NCI, which is non-controlling interest. The total, the retained earning, then share capital. So the balance at the beginning, for share capital, we have the share capital parent, which it was sitting at 200,000 from the pre-adjustment trial balance. You remember it? On page 13 or
Yes,
page 124. We have that 200,000. Then the retained earnings, it's gonna be calculated like this. You're gonna have the balance at the beginning for parent, retained earnings, it was 120, right? Do we see it?
Yes, sir.
Yes,
yes, sir.
So we say that 120. So there was the unrealized profit at the end of the year that was not sold. You remember that unrealized profit calculated here? The unrealized profit not calculated at the end of the year, which it was, you see on this 30,000. No, it's not 30,000. The 20,000 that was sold here. You remember the profit calculated here on the 20,000, which is 20 times 25 divided by 125, 4,000. This 4,000 that was realized. Ne? Now you're gonna subtract it. The reason you subtract it is because it was added before Now it's because it's realized you are taking it out. That was on the opening inventory. Because it now made a profit. We are happy.
Yeah.
So we say 120, we less that 4,000, which is coming as the 20 times 25 divided by 125 to give us 4,000. Then we add the profit from subsidiary from the analysis. The profit from subsidiary from analysis is this one. This one, it must be added here. You still happy?
Yeah.
Anyone who doesn't understand?
Sorry, sir, can you just explain 64,000? I forgot where did we get that from?
Okay. I will give it explain now.
Okay, thank you, sir.
So the 64,000 came as a result of this profit that was realized when we were doing the, you remember the since acquisition to the beginning of the current year. That was the opening balance in the books of subsidiary. So we have to take the 80% of it, which is on the 80,000. When we take the 80% of that from the 80,000, we're gonna have 64.
Oh, okay. Yes, sir, I remember now.
Okay.
Thank you, sir.
All right. Then when we add this together, they will give us 380. So the NCI will be this. When we add the 2, there will be 36 because it will be from the beginning plus whatever happened up to the, I mean from at acquisition up to what happened at the beginning. Can someone mute in the meantime? I don't know. Yeah, thank you. So when you say 20,000 plus 16, then they will give you 36. So this is the 36 that you're gonna see here as an NCI, which came from the addition of these two, the 20,000 plus 16. Because this one is come from at acquisition. This one come from since acquisition to the beginning of the current year. Because remember, we are still doing the opening balances. So when you add all this together, it will be the 380 plus 36. So like this, then they will give you 416. Any question? No question. So now we have total comprehensive income that happened during the year. Total comprehensive income happened during the year is from your income statement. On the income statement to the owners of the parent is 80,000. So we focus only on the 80,000. So here is 80,000 on the retained earnings, and then the non-controlling, they will be entitled to the 8,000 here. So in total, it will be 88. We are still fine because this
Yes,
plus
sir.
this will be. Then we can close our statement of change in equity. Then we can go to the statement of change in statement of financial position. So this calculation, I will put it up the cut. I'll put it. So our asset section will be the PPE. So the PPE, the one for parent PPE is how much?
200,000, sir.
And then for the subsidiary, it's also 200,000.
Yes.
And we have 400. Then we go to the current assets. Inventory. The inventory for subsidiary, now, listen very carefully. Now we're gonna say inventory for subsidiary parent is the one for the parent given, no changes. The parent at the end of the year, he had an inventory of how much? 50,000. Eh? Do you see it from the pre-adjustment trial balance?
Yes, sir.
And then for subsidiary, he had 30,000, right?
Right, sir.
Now, from the subsidiary one, we have to less the unrealized profit, because it means if he have an inventory of 30,000, it means he didn't sell it somewhere, somehow. So we have to subtract the unrealized profit. So we'd say the 30,000 of this closing inventory multiply by 25 divided by 125. We're happy. Does
Yes,
it make sense? This, we are lessing the profit from this 30,000 because he didn't sell the inventory. So if you didn't sell the inventory, it must be removed. That profit, it must be deducted. So 30,000 times 25 divided by 125, it gives us 6,000. So we'll say 30,000 minus 6,000 plus 50. It gives us 74. Happy? Then we proceed trade and other receivable. There won't be anything complicated there. So trade and other receivable. It will be the parent is 70 plus subsidiary of 50. Then it gives us 120. Then we're gonna have total assets, right? The total asset is how much? We add our 400 plus thingy.
594,000, sir.
Then it's 594. Then we can go to the equity. So the equity will be stated because we already done it via statement change in equity. Equity attributable of the parent is how much? Then we say share capital. We said share capital from the SCE is how much? You see is 200, ne?
Yes, sir.
Then it's 200. And then the retained earnings will be 260. And then we add the 2, they give us 460. Then we proceed. Then we're gonna have the non-controlling interest part from the SCE. Non-controlling. Which is 44, is this one from the SCE. Then we're gonna have 504. When we add the 2, then we're gonna have the liabilities. So the liabilities, it will be only the current, which it will be the trade and other payables. The one for parent is how much?
30,000, sir.
It's 30,000.
Then we add the one for subsidiary, which is 60. Then we finish with 90.
Excuse me, sir.
Mm-hmm.
When do we add taxation for the year?
The taxation, remember, is an expense. It was not recorded as a liability.
Okay.
The taxation for the year, it came here. It was featured here. Where's our statement of profit and loss? It was featured here. You see 30 plus 20 is 50.
Oh, yes, sir.
Yeah.
Okay. Thank you, sir.
Okay. Then we are done with that exercise. So in this case, the subsidiary parent was selling inventory to subsidiary. So any inventory which was not realized or was not sold by a subsidiary, it will form unrealized profit. So if it's unrealized profit for the financial year happening this year, is getting deducted. Right? So now we're gonna go to example whereby, is anyone wanna ask a question?
How did you get the retained earnings of 260?
Here it is, the retained earnings of 260. This one. Filani, you refer to this one.
Yes, that one.
Okay, but this 80,000 is come from the retained earnings happen. This one, the 80,000 is the total comprehensive income, which is come from the profit realized during the year from our income statement. Where is that income statement now? You see, the profit for the year, we have the 88,000, right? But the 88,000 is gonna be divided into two. We have the one for owners of the parent, which is 80. We are fine with this 80, ne?
Yeah, and the non-controlling.
So this 80 is the one that we're gonna put here, and then the non-controlling, the non-control of 88 it will be this one.
Okay.
And then this amount you are happy with it, ne? This 180, this one you are happy with it, where we got it. How?
Only you saw 120. I don't know how you got to 180.
So it's 120. That was the balance at the beginning, right? Then we subtracted the profit. This was the profit on the closing inventory.
Okay, I'm with you.
You remember there was a closing inventory, yeah, man, yeah, parent.
Yeah. Okay, I understand.
Okay, the opening inventory, yeah, parent, and where they said the opening inventory, the inventory on B limited financial records amount to 20,000 and 1 January. So that opening inventory, now we're gonna deduct its profit here. So here we are taking out the profit of the opening inventory because now the inventory has been sold. So we're dealing with parent selling to subsidiary, ne? So let's do a checking. The unrealized profit will affect the face value of a SFP you deduct. So if they say we're gonna deduct, let's see, unrealized profit will affect the face value of the SFP. So this is situation, this situation. This was the unrealized profit. We deducted it. You remember it. This 6,000, right? Am I still audible? Okay. Now let's check again. Now they say the unrealized profit will affect the face value of statement of profit and loss. Deduct. That's the one we did. The realized profit will affect the face value of statement of profit and loss. You add the realized. Let's check the realized. This one was the realized. We add it. Did you see this one?
Yes, sir.
So I'm trying to check the notes that I gave you on Tuesday. Now, the realized profit opening inventory of a subsidiary will affect the retained earnings on the statement of changes in equity. You deduct the realized profit opening inventory of subsidiary, which it was opening inventory of subsidiary was 20,000. And remember, okay. So if it was 20,000, they say the realized profit of that 20,000 we're gonna deduct it. Here it is on the SCE. Here we are deducting it. Do you see?
Yes, sir, we do.
And then the last one, there was another one, they will say a realized profit. That is the one we're doing, the last profit. Unrealized profit will be eliminated in the closing inventory, then calculate profit. So that one is when we are doing the SCE. So the realized profit will be eliminated on the journal. We also did on the journal. So like if you were checking on the journal, the realized profit will be excluded. Now we're gonna go to subsidiary selling inventory to parent. Before we go there should be the comments. Know that in this example, the parent sold inventory to subsidiary. The unrealized profit was therefore included in the profit. And then, and there were consequently no adjustment in the analysis of owner's equity of B Limited, but only the consolidation statement of profit and loss and other comprehensive income. We are still happy, né? With the comments from the lecture. Then now they say, also know that the sales and the cost of sale are not always given in question. You will then have to make all adjustment against the profit before tax. So if the sales and the cost of sale, they are not given, so everything will be against profit before tax. Ne? Please bear that in mind. So also, it is very important to understand the journal entries. When you know which accounts need to be debited and credited, you will know the amounts should be added or subtracted in the statement. We need to eliminate all intra-group transaction. When a shareholder or outsider evaluates the group statement, the group is regarded as one economic entity. As the single entity will not enter into transaction within itself, we should eliminate any sales between companies in the group. Therefore, we need to eliminate all the intergroup sales of 100,000 mentioned in point 3. And additional information, when these sales took place, A Limited credit the sales it sold to these goods, B Limited debits the inventory with the purchase. We assume B Limited sold the inventory, therefore we had already affected the cost of sale. To eliminate the intragroup, we debit the A Limited with 100,000, thus subtracting the amount of sales, and we create the cost of sale of B Limited, thus decreasing the cost of sale. Then A Limited sells inventory to B Limited at a profit of 25%. Inventory left at year end, and A Limited profit include the intragroup profit. Since we evaluate the companies as a single entity, we need to eliminate the intragroup profit, which it will be the unrealized profit. It was profit earned from within the group, but had not been realized outside the group. Remember, unrealized profit is debt. It comes from the sales that had not go to the public. But the minute the sales went to the public, now the profit will be realized. And when it's been realized, because it was unrealized last year, you subtract it. Now, since it was realized this year, you're gonna add it back. At year end, B Limited sold inventory from A Limited. Its financial year amounted to 30,000. A Limited made a profit of 25%. To calculate the unrealized profit, we have to recognize the 30,000 already including 25% profit, which makes 125. We calculate the profit of 25% as follows: 30 times 25 about 125, which is given as the 6,000. So we already know those calculations. To eliminate the unrealized profit of B Limited, have to subtract the 6,000 from its closing inventory in the single financial position, and we therefore credit the inventory to decrease it. We should also decrease A Limited profit by debiting cost of sale. Profit decrease when debit cost of sale, but the 6,000 is added to cost of sale referred to journal entries. In the previous year, the journal for eliminating for unrealized profit was 4,000 because it was the one which was not sold, and then performed similar to what is described above. On consolidation, we have to repeat all the entries annually because we combine the individual companies' financial records annually, and this current records do not contain the consolidation entries of the prior year. If profit was affected in the prior year, we need to adjust the retained earning in the current year. Therefore, the cost of sales of 4,000 that would have been debited in the prior year will be debited against in the retained earning in the current year. We assume that B Limited, due to the general view that the operating cycle of entities is normally a year, we assume that B Limited actually sold this inventory to outside parties within a year. Hence, the profit is realized. Therefore, we credit cost of sale in A Limited to decrease the profit again. Crediting the cost of sale implies that the cost of sale decreases. So the 4,000 is subtracted from the cost of sale in the statement. Now we go to example 4, whereby the subsidiary is selling to parent. So in this example, we are given a trial balance. So now we just have to read what's happening in the trial balance. We have share capital, we have the retained earnings, profit before tax. So most of the information will be the same, even with the amounts. The only difference will be maybe the transaction. D Limited acquired its interest in E Limited in the time of incorporation. Delimited purchase all inventory from E-Limited at cost plus 25%. The inventory due amount to 40,000 on 1 January 2008. The total sales amount to 100,000. Now we calculate do the consolidations. Okay. So subsidiary sell inventory to parent. So we're gonna start again in the same format. What will be the thing to start with?
Analysis of equity, sir. Oh, I mean owner's equity.
Before we do analysis, we have to check the interest and the everything. So it will be the same. One, check the interest.
And sir, can we have those notes you have on the side for subsidiary selling inventory to parents?
Oh yeah, okay, you are right. Let me give you the notes first. You write them, and then from there we proceed. Now, subsidiary selling to parent. Please write this portion, this one. Then I will be waiting for you. So we check the interest. But two, we do analysis. But three, we eliminate. For four, we do the financial statement then. Consolidate. So we have the information whereby they say they acquired the 100,000 shares acquired. He issued 100, and then the investment is 80,000 ordinary shares. So 80 divided by 100, it will be 80%, right? We're happy, ne? Then let's do analysis. Who is the subsidiary? E. The share capital of subsidiary is how much? So on the date of acquisition, there was no anything to do with the revaluation and the stuff. So the purchase consideration given, I will try to be faster as I explain, because here is the repetition of the same thing we know. Then we go to the since acquisition to the beginning of the current year. Since to beginning of current year. So now, as per the information given, we were told that the 40,000 of the inventory happened. What happened to it? During delimited purchase all its inventory from E Limited at cost plus 25%. The inventory on delimited books amount to 40,000 on 1 January. So on 1 January, 40,000 was representing unrealized inventory. So it means unrealized inventory or unrealized profit was 40,000 in the books of the parent. So parent didn't sell it to another person. So since it was unrealized profit last year, it means this year is going to be a realized profit. We are happy. So now we say retained earnings here as the opening balance. The retained earning of subsidiary is how much as per information given from the period adjustment trial balance? It's 80,000, eh?
Yes, sir.
So we say 80,000. Then we minus the unrealized profit because this was the profit. It was the closing balance last year. It was not yet sold. It's an unrealized profit. It will be realized during the year. But at the beginning of the year, still, if it was unrealized yesterday, it's still going to be unrealized tomorrow morning, right? So the profit which was unrealized, which you have to deduct, it was from the inventory which was not sold yesterday when we closed in our business, which it was 40,000. So we'll say 40,000 multiplied by, it was at markup of 25%, 25 divided by 125. So it's the one that we're going to deduct here. So 80,000 minus into 40,000 times 25 divided by 125, it gives us how much?
$72,000, sir.
We get 72,000. So our 72,000, we'll put it here. We all happy now? So the 80% of 72,000 is 57,600. So the difference will be 14,400. Any question up to so far? I guess there is no question. Then the profit for the year, which it will be the current year. This will be current year. So we're going to have profit for the year for subsidiary. The profit for the year for subsidiary, let's do it outside here. He have a profit before tax of how much?
No, 60,000.
Of 60,000.
60,000.
Then we less income tax expense of how much? From the pre-adjustment trial, income tax expense for subsidiary is how much?
20,000.
Okay. So we are left with 40,000. Eh? Then
Yes.
there must be the unrealized profit and the realized profit. So they told us that the opening inventory of current, he had the opening inventory of how much? Of 40, which it was the unrealized. And then, because remember, now we are dealing with things for the end of the year. If the inventory was, this inventory was not sold at the beginning, now it's going to be sold like I did before. Last, if you still remember, we had A limited, which we decided to be D limited and E limited. I said we've got sales. Let me check that information. I still have it. Yeah, I want this thing. We're gonna just change figures. Now we're gonna change it, gonna be D and E. They say they purchased it total sales of E limited amount to 100,000 net during 2008. Ne? So E limited, he have 100,000 as sales here. So it means now D limited will have 100,000 as purchases. And then the inventory at the end of the year so this one should come as 100. The revenue, he sold how much? We don't know the sales that he made. Now we want the proof, the opening balance. We have the D Limited have an opening balance of 40. So it means let's calculate the cost of sale. We have opening balance of 40. That is delimited, ne? Purchases because he purchased everything for the year from E is 100,000. Then there must be the one he sold, which we don't know yet. But all we know, Corey, the closing balance of his inventory at the end of the year, it was 50,000. So this one will generate unrealized, while this one will now generate realized. So when you are doing the things at the end of the year, the one which is realized is going to be added. The one which is unrealized will be subtracted. Ne? So this one I can just rub them off actually. So now on our thing here, profit for the subsidiary, we're gonna now add realized profit, which came as a result of which one? How much, which amount do I use? Which amount do I use here for realized profit? Sponye, Anzi, corner. Am I still audible?
Yes, sir. Is it 40,000?
So you say we're going to use 40,000. So we say 40,000 multiplied by 25 divided by 125, which give us the profit of how much? Calculate, please.
So it's 8,000.
Okay. Then unrealized profit will be 50 multiplied by 25 divided by 125, which is
10,000.
so it means we're going to have a profit of 38,000. Are we happy? So now we're going to say here, profit for the year is 38,000. We happy? The 80% of it, $30,400. The remaining balance, 7,600. So are you happy with this unrealized versus realized? The deduction and the addition part, please, you must understand this. Why am I why adding, why subtracting? Don't cram them, ne? So we can conclude.
Sir, can I ask one question?
Mm.
Sir, I'm in last exercise, we deducted that profit, that 100,000 from profit for the year. Why didn't we minus it in this example?
Okay, in the last example, what did we do?
We said minus 20,000.
We minus 20,000. I'm scrolling up. You'll tell me where you're referring to.
Okay. It's in analysis of owner's
Okay.
equity.
On the analysis. Okay, parent selling subsidiary. Here's the analysis.
Yes. That one, sir, where it says profit for the year. Then you said
Okay.
60. Yes.
That 20,000, this was an income tax expense only.
Oh,
Remember, here subsidiary was not selling anything. So this 20,000 was only income tax expense, which is this part. This 20,000 is the same as this one. It's this one.
okay. Okay, thank you so much, sir. I got it
Okay.
confused with the 20,000 of inventory.
Oh, this one is 20,000 for income tax. It was not for inventory.
Okay. Thank you so much, sir.
Okay, thank you. Then you can proceed and goes to elimination. Or they call it pro forma journal. So we're going to eliminate share capital as usual. We don't have a goodwill. Goodwill is nil. Then we have the investment in invested by 80,000. So the non-controlling interest will be the total of non-controlling interest in the since acquisition. Which is this one. So this one is just a general. We just name it NCI. It's not a big issue, this one. So we are still fine up to so far. So now we're going to go to the retained earnings, this one. Because this one is done. It's like is this. It's this one. Now we're going to go to this one now, which will form part of the, it will sit here and here. 14,400, 14,400. So it was non-controlling interest on the S. So it came as a result of the main aim here, it was retained earning. We were in the retained earnings of the, who's this? The retained earnings of the subsidiary was increasing. But since it was increased, but now we are eliminating it, the retained earnings increase on the credit side. But because now we are eliminating, we're going to debit it. And then it will be debited by non-controlling. We happy now?
Yes, sir.
Then we proceed. So this one you can just drag it further. Then we go to now, the last one. This. So we go to the 7.6. 7.6. So this will be non-controlling both sides. The other one will be SFP, the other one will be SCI. Any question up to here?
No, sir, we still fine.
Okay. Then we proceed. Then is those sales that happen between them. We have income. We eliminating them. It will be the sales, yeah. The sales from E to D. Initially, it was supposed to be credited, right? Because remember, when we sell, your sales increasing on the it's increase on which side? On the credit side, dang it. So now because you are eliminated, you're gonna say sales, which it was who sold, it was E selling. E was selling. So we are decreasing that sales of 100,000. Remember, they told us that for the year 100,000 was used as sales. Then here it will be cost of sale. We're also deducting it in the books of D Limited. And then the unrealized profit on the inventory, the one which was not eliminated, it was here. The profit, not this one. It's not yet realized. So we're gonna put it here. Then we say it's the cost of sale, because the cost of sale now must be reduced, which the reason it got rejected is because of the inventory. The inventory which was sold to, it was the inventory of 50,000, which was sold in the books of D. Remember, they told us D Limited have an inventory of 50,000. So that inventory we are trying to eliminate it. So we're gonna only, not 50, the inventory, the books of 40,000 on 1 January. I want the one at the end. It's 50,000. So we are trying to eliminate that profit from the 50,000. So it will be 10,000 as calculated. You remember here. We calculated it. Where is it? Here. That 10,000. So we can eliminate this 10,000 because it's not profit realized yet. It will only be realized when he sell it, whatever time he's gonna sell it. So our cost of sale It's not going to increase, instead going to decrease by how much? 10,000. Inventory is also 10,000. Then we have a retained earnings. So that will be on the unrealized profit. This one. Because now it was realized last year. Now it's gonna be, it's like we are reversing it. It means now the retained earnings, which was added into the retained earnings. Remember when we're doing the retained earnings here, you see it here. Because that time it was still unrealized. So now, because at the end of it will be realized, so we eliminate it. So we'll eliminate the retained earnings, because now we are reducing the retained earnings. By cost of sale. Any question up to so far? Any question?
No, sir, we're still happy.
Okay. Now we're gonna do the consolidations. So we're gonna start with the statement of profit and loss. So we have the profit before tax. The profit before tax was current is how much? Profit before tax for parent. And someone reply. It's always
Yes, sir.
replying. It's always
It's 80,000.
then the subsidiary one is 60,000.
Yes, sir.
Then we've got, you remember there was 100%, 100,000 sales and purchases that were given, that this, where are those things? the purchases that was made by D Limited and the sales that was made by E Limited. So we're gonna eliminate them here. So we're gonna say plus, let's say plus 100,000, which it will be the one for purchases in the books of E Limited. I mean D. And then we minus 100,000 for sales. In ELTD. Then now we're going to go to those realized and unrealized profit. The profit which was realized is which one? The realized profit of 8,000 will be added, right?
Yes, sir.
Then we add 8,000. We subtract the other 10,000. We add 8. We subtract. You are happy with this? I don't want to show this again because it's the same as the information that is sitting there. Yeah. This information comes here. It's this one. We are still fine, eh?
Yes, sir.
So all
Yes,
that all this calculation, when you do this long line, it will give you an amount of 138. 80 plus 60 plus, it should be 100,000, eh? 10. It should be 100. I get 138. Then income tax expense. This one is just given straightforward. As 80 plus, they give us 50. And profit for the year. Then the attributable part. Okay. Other, we have other comprehensive income. 0. And the total comprehensive income for your year. 20,000 and attributable to owners of the parent and non-controlling. So this information normally you take it from the analysis. So non-controlling, it gave you an amount of this, you see, which this 7.6 comes from here for the profit. For the profit for the year, only 7.6 will go to non-controlling. So the remaining balance between 88 and 7.6 is 80,400. When you add the two, they give you 88. Any question up to so far?
No, sir.
So the information when the subsidiary is selling to the parent, it doesn't affect much of the analysis. If you can check on the analysis, nothing much happened. It was only the 40,000 of that inventory opening balance, which it was not realized, but because it's going to be realized during the year, it's going to create profit for the year. It was only the, because that one, that's the reason in minus, it was not realized. But on the current year, profit for of 80,000 is now realized, but there will be other portion which is not yet realized. That's why the 38,000, you see how it's calculated from that question here. Now the 40,000, which the 40,000 was unrealized at the beginning, but now it's realized at the end. The 50,000 is now unrealized. So since it's unrealized, the 50,000 will be subtracted. So we're gonna go to the statement of change in equity. So it's gonna have total. It's gonna have NCI. Total again. Then any. Then share capital. Then we have balance at the beginning. Balance at beginning. So our balance at the beginning for parent is 200,000, right? As from the pre-adjustment trial balance.
Yes, sir.
Okay, hold on. Then we're gonna go to the retained earnings. The retained earnings. What was the retained earnings in the books of thingy? In the books of parent?
$120,000, sir.
Now, the one happening in the books of subsidiary, the retained earnings happen in the books of subsidiary. Now we're gonna check. It was this at the beginning of the year, because the reason the retained earnings at the beginning of the year for subsidiary is 57,600. So we're gonna add it. So it's the retained earnings. This one is for parent. This one is for subsidiary. From analysis at 80%. So when we add them all together, $177,600. Then we're gonna put it here. We are still happy.
Yes, sir.
When we add the two, we are non-controlling at the beginning of the year. It was sitting as this. When you add them, the two, the one at acquisition plus the retained earnings that happened during the, what do we call it? The since acquisition, which is the same as you see this, the 20 and 14,400. This one from the analysis is the one for non-controlling. It's either you can use this part, the at acquisition retained earnings plus the current since acquisition to the beginning of the current year, or you use this part. It's up to you. You just choose as soon as you can understand which one to choose or which one to use. Ne?
Yes, sir.
So they give us 34,400. 84,400. Then the total will be the sum of this. Then we are fine. Then we go to the total comprehensive income during the year. Total income during the year, which it will be the profit realized by. Now we have to do the consolidation. It will be the one which you remember. It will be this one. It will be this. Happy? We are happy, ne?
Yes, sir.
And then the non-control will be the 7.6. So the 7.6 will be the non-controlling part. So when you add the two, they're still gonna give you 88. Any question up to so far? Any question? Any question?
No, sir, we are still fine. Thank you, sir.
Then from now we can do the what we call the balance sheet. But the balance sheet, let me present it from here. You can see my study guide, right?
Yes,
Yes,
sir, we
sir.
can see.
Okay. So for the balance sheet section, we know this part is straightforward. It has 200 subsidiary. It was this 200, the subsidiary one, this one plus this one. They give us 400. We are happy, right?
Yes, sir.
Then the current asset, it will be the inventory, the 50,000 inventory, which is this one, plus the 30,000 inventory. We are happy up to so far here. Now, this will less. Now you see they less the 50,000 times 25. Now they less the unrealized profit. This was the come from the closing balance of the parent. You remember the closing balance of the parent, this one, when they say the parent had inventory of 50,000 at the end. So since you have inventory of 50,000 at the end, you have to deduct the profit from this inventory. So you say this plus this, then minus the profit on this. Be happy with this calculation.
Yes, sir.
Because the reason we are subtracting it is because it's unrealized. Unrealized meaning it's not yet sold. As far as it's a closing inventory at the end of the financial year, it means it's not yet sold. It will be unrealized. Then we get 70,000. So the trade and other receivable is just straightforward, no issue. So the share capital of 200,000 is now coming from our changes in equity. Remember when we do our changes in equity, we had 200,000, and then when we do the 258 of retained earnings is this one, you see, and then not from there there's nothing other major. So the non-controlling interest of 42,000, it will be the total that I show, which is this one. Like when you are doing your pro forma journals, you can show this thing of NCI. It's either you take this here, they'll give you 42, or you use the one from analysis, which it will be this one. The whole total of analysis, it can be a non-controlling on the statement of financial position. We are happy, right?
Yes, sir, we are.
And then the trade and other payables of 90 is the one for parent and plus the one for subsidiary, they give us 90. So there's no other major information. Everything here, we discussed it. Then it can only be the comments from the lecture. Then from there we'll be done. So the comment that says since subsidiary is in this example has sold the inventory and made the profit, we should also bring into account the adjustment in respect of the unrealized profit in the analysis of the owners. You have probably realized that we can quickly test whether the analysis of owners equity balance. So it's at acquisition plus since acquisition plus non-control, it gives us 210. To see whether the NCI column has been correctly calculated, we can say the total of 210, then NCI equals to 20%. So you say 210 times 20%, you must give you 42,000. So whatever you say 210, the 210-year NCI, which is this 210, the 210, this one, when you multiply by 20%, you must give you 42,000, just to check if everything balanced. Yeah, me, I will stop from here. And then let me share I'm gonna now create the WhatsApp groups for both modules. 072-453-5744. You type your name and the module, then I'm gonna create the group. Ne?
Yes, sir. And sir, when is the next class?
The next class will be on Saturday, same time of 12:30 to 2:30.
Thank you so much, sir.
So
for
now the only thing I have to make sure that I deal with is this thing of recordings. They must make sure that they upload these recordings. People, they want the recordings with their pink eyes and they can't find them.